On the 1st of December 2024, Intel forced out its chief executive. He had joined the company at 18. He was removed over a bet that had not paid off. 20 months later, Intel is growing faster than it has since 2011. And the stock is up about 5 times. So, was he right? There is one line in Intel's own accounts that answers that, and it is not the revenue and it is not the share price. By the end of this, you will know exactly where that line is and what it currently says. He had run the company for less than 4 years. So before we get to that line, some context on why any of this matters beyond one man's career. For 30 years, Intel did something almost nobody else attempts. It designed chips and it built them. Everybody else split those two jobs apart. Design went to NVIDIA, to Apple, to AMD. Manufacturing went to Taiwan. Intel kept both. For a long time, that was the moat. Then it became the problem. And it stopped being a business question somewhere around 2022, when the ability to manufacture an advanced chip turned into a matter of national strategy. Intel is the only company in America that can still credibly attempt it. So the real question is not whether the stock recovered, it is whether the factory did. Pat Gelsinger arrived at Intel in 1979. He was 18, he had no degree, and his job title was Quality Control Technician. 10 years later, he was the lead architect of the 486. That is the chip that put Intel into essentially every office on Earth. He was mentored by Andy Grove. He became the company's chief technology officer in 2001, and then in 2009, he left. The top job went to somebody else. He spent the next 12 years running other companies. While he was away, 2 things happened. In 2006, Apple asked Intel to build the processor for a phone it had not announced. Intel said no. The price Apple wanted was below what Intel believed the chip would cost. Years later, Paul Otellini admitted the forecast had simply been wrong. The volume turned out to be enormous, and the entire calculation had rested on the volume. That is the famous mistake. It is not the fatal one. The fatal one was quieter, and it happened inside the factories. Intel's next manufacturing process, 10 nanometer, was due around 2015. It slipped. Then it slipped again. For years, the best chip designers in the world were handed factories that could not build what they had drawn. In 2021, they called back the technician. He came back in February 2021, 30 years after he had first walked in, to fix the one thing that had broken while he was gone. The plan was not subtle. 5 new manufacturing processes in 4 years. That was the actual internal slogan, and in an industry where one node normally takes 2 years or more, it was close to absurd on purpose. And then the genuinely radical part. Intel would open its factories to everyone. Any company could have their chips built there, including the companies beating Intel in the market. The plant that had always existed to serve Intel would now serve Intel's rivals. To understand why that is such a leap, look at who he was chasing. Taiwan's TSMC does not design anything. It has no products of its own, no brand on a laptop, nothing to protect. It exists purely to build other people's chips, and that focus is exactly why it won. Everyone trusts it, because there is nothing to be nervous about. Gelsinger was proposing that Intel become that, while also remaining Intel. New plants in Arizona, in Ohio, in Germany, tens of billions in capital spending, in a business where a single machine can cost more than the building around it. Then the bill arrived. On the 1st of August 2024, Intel announced it was cutting around 15,000 jobs, more than 15% of its workforce. On the same day, it suspended the dividend it had paid for more than 30 years. Over calendar 2024, the shares fell 60.1%. For a company of that age and size, that is not a bad year. That is a crisis. 4 months later, the board ran out of patience, and we are back where this video started. He was given 4 years to reverse something that had taken more than a decade to go wrong, and he was removed before the bet resolved. Now, the board's side of that is not unreasonable. 4 years, tens of billions spent, no visible payoff, and a share price down 60%. At some point, patience becomes negligence. The market agreed with the board. In April 2025, Intel closed at $18.13. Its entire value was about $79 billion, the lowest since 2009. The company that had defined computing was, for a moment, a mid-sized business. And then something happened that has very little precedent in American corporate history. In March 2025, Intel hired Lip Bu Tan, a semiconductor veteran, formerly chief executive of Cadence, and a former member of Intel's own board. The stock rose about 12% on the announcement, which tells you how badly the market wanted anybody with a plan. That is the normal part of the story. Here is the rest. In August 2025, the United States government converted its CHIPS Act support into equity and took roughly 10% of Intel. Not a loan, not a grant, ownership. The federal government became one of the largest shareholders in an American chip company. The following month, NVIDIA invested $5 billion alongside a technical partnership. Sit with that one. NVIDIA is the company that took everything Intel used to have: the market position, the margins, the status as the most important chipmaker alive. And NVIDIA wrote a check to keep Intel going. SoftBank added $2 billion. So a company that could no longer raise money on its own merits was recapitalized by its government and by the rival that had beaten it. That is not a turnaround. That is a rescue. And this is the trap. On a stock chart, a rescue and a turnaround look identical. Both lines go up. Only the accounts can tell you which one you are holding. Which brings us to the accounts. Intel's second quarter of 2026. Revenue, $16.1 billion, up 25%, the fastest growth since 2011. Data center and AI, $6.3 billion, up 59%. Gross margin, 40.4%, up nearly 13 points in a single year. On every one of those numbers, this is a company that has recovered. Now go further down the same report to the segment called Intel Foundry. That is the manufacturing arm. That is the bet. That is the reason the dividend went, the 15,000 jobs went, and the chief executive went. Revenue, $5.8 billion, up 31%, genuinely growing. Operating loss, $2.089 billion in a single quarter. That is the cost, but it is not the answer. And this is the part almost nobody reports. Of that $5.8 billion of foundry revenue, the amount that came from customers other than Intel was $293 million. That figure is Intel's own, from its chief financial officer, $293 million out of $5.8 billion, around 5%. So read that carefully. The entire point of the bet was to build a business making chips for other companies. 5 years, tens of billions of dollars, a suspended dividend, 15,000 jobs, and a chief executive later, 95% of Intel's foundry is still Intel, making chips for Intel. The factory got better. That part is real, and you can see it in the losses narrowing. But the customers have not arrived, and that is not an accident or a sales problem. It is the hardest structural problem in this industry. And it is about trust. Think about what Intel is actually asking. It wants Apple or Qualcomm or NVIDIA to hand over the design of their most valuable product years before launch to a company that also competes with them. TSMC never has to answer that question. It has nothing of its own to protect. No amount of capital spending fixes that. A customer does not sign because your factory was expensive. They sign because 2 other customers went first and nothing went wrong. That is why the external number moves slowly, and why it is the honest scoreboard rather than the revenue line above it. So, was he right? On the diagnosis? Clearly yes. Intel did not fall because it designed badly. It fell because it manufactured badly, and manufacturing was the thing that made it special. Everyone now agrees with the man who was removed for saying it. On the cure, we still do not know. And that is the honest answer rather than a satisfying one. The company is healthier. The factory is better. The bet he was removed over has not reported back yet. And $293 million is what it has to show so far. 3 things to take away. 1. Intel's problem was never design. It was the factory. And the factory was the moat. 2. The rescue was not commercial. Its own government and its biggest rival put the money in, which means Intel is now too strategically important to fail. That is not the same as being healthy. 3. Ignore the headline revenue. The number that tells you whether 5 years and a chief executive bought anything is how much of Intel's foundry revenue comes from anyone other than Intel. Intel reports again in October. That is the line to find. Share this one. Subscribe for the next.